buying interest rates. And now we're going to do a whole segment looking at how you could get long interest rates, but in the long term. And Jermal, I want to get your vibe on this, but my thing is always like, I've got two parts of my trading brain, which is what's going on right now and what can I get in and out of in the next couple of minutes to couple of hours. And then the other part of my brain is like, what's going on right now in the context of, the larger picture, the more kind of bigger price extremes, macro events and everything else. And I'm totally comfortable being on either side of the same market in those two parts of my brain, because if I'm long interest rates, and we're going to talk about buying interest rates for the long term, and then we see a big rise in rates in the short term and I sell it, then when I buy it back for that day trade, then I'm back to my long term. Like, is this all kind of making sense that you have in futures, kind of these two parts of your trading brain?
Most definitely. You can make a case, right, for the fact that these rates are rising right now, particularly near-term rates. And it's for a valid reason that we're going to see some rate hikes coming up in the time being. And so where does that 2-year duration put you out to, right? And again, this perfect slide where we have Fed funds rate probabilities. We see, for the most part, that majority of the people are on the side of the 1 to 1.25%. So you can make a case for the idea of buying rates, right, in the near term. If we're going to continue to get this near-term buying pressure, then why not play along with it?
Exactly. And so we're going to look into how you can get that done, and also how you can, even with the recent rise, skew the odds in your favor, feel a little bit better about buying rates at highs for the last year or so. And here you have the Fed funds rate probabilities, which is a projection using futures on what the Fed funds rate is going to be. It projects where the market thinks they'll be in a future date. And so we're looking for 2022 here, and you can see the highest concentration is around 100 basis points or 1%. Right now we're at 0. And so this would mean the Fed would need to hike 100 basis points this year, which is kind of a tall order. Something the Fed of years recently has not done. They've not been, as long as I've been a trader the last 6 or so years, I haven't seen an aggressive hiking Fed yet. It's usually 25 basis points, and then we skip a couple meetings, and then another 25. Maybe you get 75 basis points in a year, but they're projecting at this point now today over 100 basis points, which would be 4 traditional Fed rate hikes.
The last 50 basis point rate hike we had was May of 2000. I just saw this today.
Wow. That is kind of crazy. I mean, for context, everybody, the year is 2022. 22 years here since we've seen a greater than 25 basis point hike from the Fed, which isn't to say we can't see it. And guess what? It's not only, these projections could be off, the market's off, whatever. The 2-year Treasury is almost exactly in tandem with these projections and everything else. It's all a cohesive environment. It is no coincidence that you're seeing the S2Y futures now at highs since they've been created in the last year here at $10, which is 1%, which correlates directly with this projection that you're seeing from Fed funds and what everybody is saying about the Fed. Everybody is thinking short-term yields are on the rise in an aggressive manner. And that's why you've got these futures they've gone from 0 to $10, which is 1%. I mean, this looks like a crypto market almost, right? Like 0 to $10 like that. They're up in the last couple of months here, up 400% in this market. And you might say, how the hell am I going to buy a market that's up 400%? Are you out of your mind? Even at 1%, Jermal, we're not halfway back to where U.S. Treasuries have been. I mean, did these stats catch you off guard? These are the current rates as of about a week ago relative to the highs since 2010. I mean, we've seen 3% in 2 years. We've seen 4% in 10 years, almost 5% in 30 years. We're not even halfway there, even with the upside we're seeing today.
This definitely caught me off guard. I don't even remember The 10-year treasury being 4%. But again, I am a very rare case, which is the reason why we were able to create the leap. As much as I was aware of the 10-year, I wasn't aware of the 10-year. I didn't track the price regularly. I didn't really pay attention to it and correlate 10-year price of 4% to wherever, S&P was trading at the time. So I would say I am in a different case, but this is fascinating considering that, like you said, all three of these durations are not even at half of where they were in their highest times. That's fascinating.
And so you can feel like, yes, would it be nicer to have bought the zeros in 2 years when all the rates were at zero? Yeah, it would have been nice. But I was kind of one of the only lunatics on financial media being like, these rates are going to go up at some point, like a year ago. And everyone's like, what the hell is this guy talking about? He's like, he's talking about rates. No one's talking about rates, dude. Everybody's talking about crypto and everything else. And I'm wrong about a lot of things, but interest rates are just so consistently mean reverting, which is to say when they're at their lows, at some point they come back, and we're at their highs, at some point they come back. And so yes, you're not buying the lows, but you are buying, if you're buying interest rates even today on one of the biggest up moves we've seen in treasury yields in a while, you're still buying it below the average price. Now, if you think this is too much too soon, and I'm kind of in this camp in the short term, yeah, I'm selling these multi-year highs for, a $30 scalp, a $40 scalp. But in the long term, you can feel comfortable setting up a covered call. Here we have it in the 30-year. It's very, very straightforward. You buy one S30Y, Jermal, you sell a call in TBT. We're going to have options on these products very, very soon. But you can go over to TBT. It's 1-to-1 here to sell that. I would just go and sell that 20 call or whatever fits your fancy, and out of the money call in TBT against my long 30-year. I reduce my cost basis. I'm buying a little bit lower, and I'm long yields. I mean, this is pretty straightforward, right?
Yeah, it is. But just for those who don't get it, because I had to remember myself what TBT was. TBT is what is it? It's the inverse of yield prices, right? Long 20-year yield prices.
This is where the world gets prices. No, you nailed it. It's funny because it's not, TBT isn't technically a yield product, but it's funny because there's TLT, which a lot of people know, which is like the 30-year bond ETF. TBT is the inverse of that. And if you're thinking to yourself, well, aren't yields the inverse of bonds? Ding, ding, ding. Yes, they are. But this product is technically, it's technically an inverse bond ETF, which for all intents and purposes, especially for today's trade, it's yields, right? Like it's 30-year yields. And so you could sell the call against it in TBT. Where things get a little hairy is you want to go to the short term. You want to get directly to the source, directly to what the Fed is touching, the short-term rates. And I want to buy some S2Ys. First of all, it's a smaller product than S30Ys, so lower buying power and everything else. It's more comfortable. I can buy a few of these, Jermal, and sell, but here's the deal. There's not an inverse 2-year note ETF, which makes things a little tougher. I'm selling a ZF put. That's kind of weird, right? Because what's ZF?
Well, ZF is, so this is interesting because isn't ZF ZF is the 10-year note, right?
It's a 5-year note.
5-year note. Yeah, sorry. ZF is a 5-year note. Now there is a 2-year note, right? ZT. So why not use that one?
2-year notes have awful options, and there is no better, because you would prefer to go directly. Okay, I'm buying 2-year yields. I want to sell 2-year note puts, and it seems kind of hairy, but the inverse idea of it is like selling calls in the 2-year yield by selling puts in the 2-year note. The options are brutal in that market. The 5-year is very, very similar. It's just a couple more years of duration, very highly correlated to 2 years, but you would need to do this on a ratio basis. But I like this a lot, buying 5 2-years, Jermal, and selling 118.5 put in ZF, and I'm nice and hedged up, and I'm buying those 2-year yields, Jermal, a good deal lower than their highs here. And so that's how you can buy interest rates with these products straight away, and they cost you just a couple $100 to trade. But if you want to reduce the cost basis, get better odds, given that we're at the highs, you can put some options on top of it.
It's interesting, man. You went deep there. So in that case, we're getting long yields.